they keep talking, right? The different speakers, Fed speakers, and a lot of opinion there. Dean Kim is head of global research product at William O'Neill and Company. Is joining us right now. Dean, great to have you with us here. Thank you very much for your time. How are things looking? Are they muddied a bit more as we approach the end of the year? Because volumes globally have also dropped off. In the US, for example, this week there's this Thanksgiving holiday. Volumes were low. This pullback rallies seems to be fizzling out. Equities are down, rates are up, and you've got the dollar, which is higher as well. What's your sense?
Yeah, I mean, it's interesting. We've heard the Fed speaker just now, and economic data is everything. So we had a good reaction to lower than expected October CPI reading on November 10. And so the S&P 500 reacted really well in the print, and the index continues to find support at the 100-day moving average, with the next resistance at basically 200-day moving average, which is 3% higher. NASDAQ reacted also positively as well, but the index has yet to break above the 100 DMA that the S&P managed to do, and still has 200-day moving average resistance to contend with as well. But as long as both indices stay above the intraday lows of November 10, we would continue to label the U.S. market in a confirmed uptrend. And so I think every bit of data that we see going forward, whether it be CPI data or employment data, I think it's going to be critical in terms of predicting where the Fed is going to go. So if we get another reading in December 13 for November CPI reading, and it comes in lower than expected, I think the market has a chance to, sort of get a year-end rally. So that's where we're sitting right now. Okay.
Dean, hi, good morning, and thanks for being with us. What about your view on the Nifty? Given all the volatility, we're still above the 100, 200 and 50-day moving average on the Nifty. So do you think that the uptrend is intact, and what are the levels to watch over the next couple of months?
Yeah, I mean, Indian market has been fantastic. We do notice that if you look at AAXJ, which is the ETF, Asia ex Japan, there has been a bit of a character change. So AAXJ has broken above the 100-day moving average, hasn't done that in quite a while. And it is kind of retreating a little bit, but I think that's an interesting character change. India, continues to be on the confirmed uptrend path. We see next support 1% away at the 21-day moving average. I'm talking about the Sensex. And as well, there's a 50-day moving average support, which is 3% away. The market continues to look pretty solid. I mean, last time I was on, I commented we should avoid extended stocks. I continue to see some extended stocks, but also glad to see a lot of stocks breaking out from early stage basis. So that's a great sign. It's a very healthy market. Plus, on top of that, you have oil prices kind of retreating, and as well as U.S. dollar retreating as well. And I think they're supportive of India as well as rest of Asia, in fact.
Hi, Dean. Good morning. Since you spoke about crude as well as the dollar index, where do you see both those two headed? It's very, very important from an India market perspective.
Yeah. I mean, for U.S. dollar, we see, it's sort of in a downtrend at the moment. We see next support at 105. That's sort of like the 200-day moving average. So if it breaks that level, then I think it could go a lot lower. But then if it reverts on the upside, we see 109 as resistance. So we're kind of in those two ranges. So we'll see how it goes. But I believe U.S. dollar is going to test support at 105, given the fact that, perhaps the Fed is going to start easing off in terms of raising rates. So that's usually, a better sign for the U.S. dollar to sort of back off. As for oil, we're currently at around $80 in terms of index. I think it's poised to downside support at $76 and then at 73. So I wouldn't be surprised if oil continues to go lower. If you look at the demand globally, For example, inflation in the U.S., if you look at the demand side, is only 1%. It's the supply side, supply-driven inflation that's the problem. I think that speaks to oil prices coming down globally. There's just not as much demand given economic cycles that we're in.
Yeah, I mean, that's true. But that's been true always, right, Dean? I mean, world oil demand growth grows, what, 1.5% annually. That's it. And that the pace of that increase is also coming off. Dean, a quick point on expectations of Fed starting to ease off, etc. The point is they may not, the pace of hikes may come off, but they may take it up, the rates may go up to 5 and then stay there for 6 months, right? Now, that'll be painful for some time. So do you expect markets to react in anticipation of when, the 6 months will be over, or only once the Fed actually starts to cut rates will, markets respond? What's your sense?
I think first we have to deal with the data that's going to come through. So, for instance, CPI data, if it comes in lower again in December, I think we'll get a positive reaction, and then reactions from non-farm payroll, employment type data, if it comes in weaker than expected, then I think we're going to get a positive reaction. Also, I keep looking at inflation break-even data going forward, and the bond market is expecting 2.3 to 2.5% inflation by the end of 2023. So if that is the case, then I would expect the Fed to, at some point, completely reverse and start cutting rates, perhaps, third quarter, fourth quarter next year. But market's going to be reacting well ahead of that. And so, I wouldn't be surprised if the U.S. market starts to accelerate sort of midpoint next year.
Okay, the U.S. market starts to accelerate midpoint next year. That's, I guess, an optimistic view coming in. Dean, always a pleasure speaking to you. Thanks a lot for taking the time out and speaking to CNBC TV 18. That's the word on the global